Companies often invest in equity securities issued by other entities. Recall that one of the rights associated with owning equity is the right to influence management. In many companies, this right comes in the form of a right to vote for the board of directors, and the number of votes is in proportion to the number of shares owned. In this video, we provide an overview of equity investments and illustrate the methods used to account for investments that do not constitute a controlling interest in the issuing entity. That is, the investor does not own enough votes, usually 51%, to control the actions of the investee's managers. In general, investments in equity securities are classified into three categories. 1. Equity investments that result in the investing company having no influence in the decisions of the investee entity. 2. Investments in equity securities that result in the investing company having a significant influence on the decisions of the investee entity. And 3. Equity investments that result in the investing company having control over the decisions made by the investee entity. The first category, no influence, includes equity securities that represent an equity interest too small to exert any meaningful influence on the management of the investee company. As a guideline, U.S. GAAP considers investments of less than 20% of the equity to meet this criterion. The significant influence category includes equity investments large enough to exert influence, but not control, over the management of the investee company. The guidelines here are ownership of 20 to 50% of the equity. And the investee company is referred to as an affiliate company under U.S. GAAP or an associate company under IFRS. Also, it is not unusual for this category to include joint ventures, where two or more companies enter into a partnership designed to achieve a common goal. The third category, control, includes investments where the investing company, called the parent, controls the decisions made by the investee company, called the subsidiary. This category, where ownership is normally greater than 50% of the equity, includes mergers and acquisitions. Note, in the cases of equity investments across the three categories, the ownership percentage serves as guidelines, not rules. What is really important for proper categorization is the level of influence, which can be exerted in many ways in addition to the percentage of ownership, including, for example, board membership, customer-supplier dependence, and other factors. Each of the three different categories of investment requires a different method of accounting. In the case of no influence equity investments, which appear on the balance sheet as either current, short-term, or non-current long-term assets, an accounting method based on the market value of the securities is used as long as market prices are readily available, as in the case of publicly traded securities. This method, which we discussed in video 36, values investments on the balance sheet at their current market prices and treats the two companies, investor and investee, as if they are completely independent. In the significant influence case, the equity investments are considered long-term assets on the balance sheet because the reason for the investment is rarely simply to purchase and sell the securities at a profit. Normally, there is a longer run, strategic reason for the investment, and an accounting method called the equity method is used. This method treats the two entities as if they have a common overlapping interest. Finally, equity investments that create control of a parent over a subsidiary are accounted for using the purchase method, which leads to consolidated financial statements that depict the entities as if the subsidiary is contained within the consolidation of the two entities. In the remainder of this video, we illustrate the accounting methods used to cover the no influence market value and the significant influence equity method. The control purchase method of accounting is covered in the next video, video 38 in this series. Within the no influence market value method category, The equity investments are carried on the balance sheet at current market prices, and changes in the prices or market values of the investments during the year appear on the income statement and affect net income. To illustrate accounting for equity investments that exert no influence, assume that 100 equity securities are purchased for $10 each on day 1, giving rise to this entry and posting $1,000 to the investment general ledger account, which would link directly to the balance sheet. The $1,000 cash payment, as well as any cash proceeds from the sales of these securities, would be considered investment activities on the statement of cash flows. If on day 2, 20 of the securities are sold for $12 each, a realized gain of $40 would be recorded and appear on the income statement, and the investment account on the balance sheet would be reduced by $200. If on day 3, 30 securities are sold for $9 each, a realized loss would be recorded and appear on the income statement, and the investment account would be further reduced to a $500 balance. Assume further that on day 4, the investing company received a $20 dividend. Income would be recognized, increasing earnings on the income statement. Note too that this transaction does not affect the investments account. Assume that it is the end of the period now and the time to prepare the financial statements. 50 securities remain in the portfolio. Recall that 100 securities were originally purchased and 50 were sold during the period. The end of period EOP per unit market price is $13, indicating the market value has risen above the original $10 purchase price. The market value method requires that the balance sheet value be set equal to the market value. Consequently, the investment account will be increased by $3 for each of the 50 securities, a total of $150, bringing the balance sheet value up from $500 to $650, the market price, 50 securities times $13 per security. In addition, an unrealized gain of $150 will also be recognized and will appear on the income statement, increasing net income. Had the end of period market price dipped below the $10 original purchase price to say $8, the investment account would have been reduced by $100 to $400, and an unrealized loss of $100 would have been recognized. We just completed an illustration of the market value method of accounting, which treats the investor and investee entities as two separate independent entities by carrying the investment on the balance sheet at market prices and reflecting price changes in the securities on the income statement as unrealized gains and losses. Now we move to the significant influence equity method, where the two entities are viewed as having overlapping interests. The key elements of the equity method that reflect this overlapping interest are that each year the investor company records its proportionate share of the earnings reported by the affiliate company, and dividends received by the investor company from the affiliate serve to reduce the investment account on the investor company's balance sheet. Let's move to an illustration. Assume that an investor company purchases 1,000 shares, 40%, of affiliate company's 2,500 outstanding common equity shares for $5,000. Assume further that this transaction creates a significant influence over the business decisions made by affiliate company, meaning that the equity method of accounting should be used. This transaction results in an increase to the long-term investment account on investor company's balance sheet, as well as a reduction in cash. Like the cash flows associated with buying and selling smaller equity investments discussed earlier, this cash payment would also be considered an investing activity on the statement of cash flows. During the year, affiliate company declares and pays an $80 dividend to its shareholders, 40% of which, $32, is received by investor company. Since the dividend is a liquidation of affiliates' assets, meaning that affiliate is now smaller, investors' long-term investment in affiliate, which represents 40% of affiliate, is reduced on investors' balance sheet. In effect, the dividend represents a conversion into cash of a portion of investors' investment in affiliate. When, at the end of the period, EOP affiliate reports positive net income of $200, investor company records its 40% proportionate share of those profits, $80, and at the same time increases its long-term investment account, leading to an ending balance of $5,048. Affiliates' $200 net income represents growth in affiliates' wealth, and under the equity method, investor company records its proportionate share, $80 or 40% of that growth. Had affiliate reported a $100 loss at the end of the period, investor would have booked its proportionate share, $40 of that loss, and reduced its long-term investment account, leading to a final balance in the long-term investment account of $4,928. Now that we have covered the market value and equity methods of accounting, let's examine how it looks in the real world by reviewing the 2006 financial statements of the Walt Disney Company, a giant in the entertainment business that holds no influence investments accounted for at market value and significant influence investments accounted for under the equity method. We begin by looking at the assets section of Disney's balance sheet. And there we see a long-term investment account of over $4.2 billion as of October 1, 2016. Footnote 5 provides more detail on these investments. Of the $4.28 billion reported on the balance sheet for 2016, the lion's share, almost $4.1 billion, are investments accounted for using the equity method. Later in the footnote, Disney reports that these equity basis investments represent significant influence over A&E, Arts and Entertainment, BAMTech, a Major League Baseball streaming technology, CTV Specialty TV, Hulu, the well-known streaming service, 7TV, and Vice, a media company aimed at millennial audiences. The $198 million invested in other investments is the market value of the investments Disney carries where it has no influence over the management of the investee entity. Disney's 2016 income statement shows equity in the income investees of $926 million in 2016. This amount was recorded by recognizing Disney's proportionate share of the income reported by the investee companies, A&E, BAMTech, CTV Specialty TV, Hulu, 7TV, and Vice. Here's the entry recorded by Disney to create these earnings. Debit left side to the investment account we saw on the balance sheet, and credit right side to earnings, which increased Disney's net income on the income statement. Any unrealized and realized gains or losses on the no-influence investments held by Disney were likely included along with other relatively small expenses and revenues in the account Other Expenses Net. Here are the operating and investing sections of Disney's 2016 Statement of Cash Flows. The operating section, where net income of $9.79 billion is reconciled with cash provided by operations of $13.2 billion, contains several items relevant to Disney's investments. First, gains on the sales of investments and dispositions would include the realized gains on the sale of no-influence investments. These are subtracted from net income on the statement because, as the entry shows, the gains increased net income but did not provide any operating cash. The cash collected on these sales was included in the investing activities section of the statement. Second, the $926 million behind equity in income of investees, the same $926 million that appears on Disney's income statement, is also subtracted from net income. Again, the entry that led to this amount, as shown above, increased net income, but did not provide any operating cash. The operating section of the statement also discloses cash dividends received from equity investees. This $799 million, a positive number, represents the dividends paid to Disney by A&E, BAMTech, CTV, Specialty TV, Hulu, Seven, and Vice during 2016. As the entry shows, this amount provided operating cash, thus the positive number, while at the same time reduced the long-term investment account on Disney's balance sheet. Finally, a look at Disney's footnotes explains that the $850 million cash outflow in the investing section of the statement represents the fact that during 2016, Disney bought a 15% equity interest in BAMTech, the Major League Baseball streaming technology, for $400 million, and invested another $450 million in Vice, the media company aimed at millennials. Both investments made in 2016 were accounted for under the equity method.